What if your cash could generate 7% returns in a secure manner through crypto? Are you willing to give it a shot? DeFi, or decentralized finance, is more than just high-risk speculation. It also provides low-risk opportunities to achieve yields that surpass many traditional bank accounts. Today, we're focusing on DeFi tailored for retirees, ways to invest your money in crypto safely and wisely. When approaching retirement, safeguarding your capital is crucial. You cannot afford to gamble your nest egg on trending meme coins. The encouraging news is that crypto strategies emphasize stability and reliable income rather than high-stakes bets. Let's delve into several options. 1. High-yield stablecoin accounts, like DAI savings rate and others. One of the most straightforward and secure DeFi yields comes from stablecoins. These cryptocurrencies are tied to the US dollar and can be thought of as digital dollars. Some protocols generate interest on stablecoins by investing them on-chain in low-risk ways. A leading example is MakerDAO's DAI savings rate, DSR. MakerDAO, a prominent DeFi platform since 2017, has its own stablecoin, DI. In mid-2023, they began allocating a portion of its reserves into tangible assets such as US Treasury bills. This strategy enabled them to increase the DAI savings rate to 8%. Yes, 8% on an asset resembling a dollar, achieved through decentralized smart contracts. After minor adjustments, the rate typically resides within a 5–8% range. Here's how it functions. You deposit DI into the DSR contract via an app like Oasis. Your funds continuously earn this interest rate, with the option to withdraw at any time. It resembles a high-yield savings account for your stablecoins. The associated risk is relatively minor since DAI is over-collateralized, and the yield stems from secure investments, including Treasury bills and revenue from Maker's borrowers. However, keep in mind that DAI is a stablecoin. Its value depends on maintaining its peg. Historically, Maker has succeeded in sustaining DI's $1 peg, aside from minor disruptions like those seen in March 2020. For retirees, allocating cash to DI and depositing it in DSR could provide significantly better interest than a conventional bank, while still holding dollar-like assets. Another option involves lending stablecoins on Aave or Compound. These reputable DeFi lending platforms allow you to supply, for example, USDC, a leading regulated stablecoin, and earn interest from borrowers. Yield rates fluctuate based on demand, often registering a few percent APY. Though not as high as the promotional DAI rate, Aave and Compound have impressive security track records. At times, stablecoin yields on Aave can surge to 5–10% when demand is considerable. The funds are easily withdrawable, making it comparable to or even better than a money market fund yield, with interest accruing with each transaction. For stablecoin yield safety, consider these tips. Stick to established stablecoins, USDC, DAI, and possibly USDT, Tether, if you trust it. Tether's backing can be somewhat unclear, but it has maintained its peg. Many prefer the transparency of USDC or DAI. Diversify stablecoins if investing a large amount. This strategy helps mitigate exposure to any single issuer's risk. Use audited and reputable protocols like Maker, Aave, and Compound. These platforms have been rigorously tested. Avoid random new platforms promising extravagant yields. Claims that seem too good to be true likely are, and may involve hidden risks or schemes. Consider DeFi insurance. Platforms like Nexus Mutual or InsureAce offer coverage for smart contracts. By paying a small premium, you gain financial protection in case the protocol fails or gets hacked. For instance, if you invest $100,000 in Aave, paying a few $100s for insurance annually can bring peace of mind. While this will slightly reduce your yield, turning a 5% net yield into approximately 4% through insurance may be worth the security. 2. Tokenized real-world assets, bonds, etc. An intriguing trend is the integration of traditional financial yields within DeFi. As we discussed, Maker uses treasuries to underpin DAI. Numerous projects are issuing tokens representing treasury bills or corporate bonds. For instance, Ondo Finance has a token, USDC Yield, also known as OUSG, which allows on-chain access to short-term US Treasury yields. They manage T-bills and issue an ERC20 token that accrues value. Current yields on 3-month T-bills hover around 5%. and these tokens aim to replicate those yields. Another example is Franklin Templeton, a major asset management firm, which has launched a tokenized money market fund on Polygon called Benji, FOBXX. This fund invests in government securities. Consequently, you gain a regulated money market fund yield with the convenience of a crypto token, primarily utilized by institutions now but indicative of future trends. For retirees, allocating funds to tokens like OUSG or Benji can provide similar yields to those of traditional money market funds, now within the DeFi ecosystem. You could potentially leverage or trade these funds easily. The main risk relates to issuer trustworthiness. Ensure that the provider holds actual bonds and the structure is secure. These tokens are relatively new and lack high liquidity at the moment, but since they're regulated under frameworks like SEC Reg D, they stand as a bridge between traditional finance and DeFi, offering familiar assets in the crypto space. 3. Staking blue-chip crypto with caution. We previously discussed staking, but if you're a retiree, it's wise to primarily focus on stablecoins. However, if you possess Bitcoin or Ethereum in a diversified investment portfolio, you can also earn passive income with relatively low risk. Ethereum allows staking through direct staking of 32 ETH, or via services like Lido or Coinbase, yielding around 4 to 5%. This method is relatively secure now that withdrawals are available. You can exit when needed. Bitcoin yield presents a more complex scenario without resorting to centralized lenders, many of which, like BlockFi, have faced issues. An emerging opportunity is the Lightning Network. By running a Lightning node and providing liquidity, you earn transaction fees. This method is technical, and yields tend to be modest unless one is highly knowledgeable. Protocols like Sovereign or Stacks present additional yield opportunities for BTC, but these are more experimental. Therefore, it is advisable to hold BTC and not chase yield through unknown platforms, considering past incidents where people lost BTC in failed lending services during the 2022 collapses. 4. Use well-regarded CeFi earn programs as alternatives. CeFi refers to centralized finance. Following the 2022 upheaval with firms like Celsius, many remain rightfully cautious. However, some regulated entities still offer appealing yields. For example, Coinbase provides USDC staking, currently yielding around 4% APY, essentially staking USDC within Circle's program, which invests in short-term treasuries. Coinbase is publicly traded with transparent financial reports. Kraken and other exchanges also offer crypto staking, like Kraken's ETH staking. Note that in the US, Kraken had to discontinue certain offerings due to SEC-related issues, but they remain operational internationally. Many neobanks and fintechs incorporate stablecoin yields in their services, as seen with Revolut utilizing DeFi in the background. If opting for this route, consider distributing investments across several providers for larger sums while remaining within insurance thresholds. Some offers might utilize banks with FDIC-insured structures, for instance, up to $250,000. Using Coinbase's USDC yield can be straightforward for retirees. Simply hold USDC on Coinbase, toggle the Earn feature, and you can receive around 4%. While not the highest yield, this approach is very simple and relatively trustworthy. 5. Prioritize security. The primary risk for newcomers in DeFi lies in making mistakes or falling victim to scams. Retirees may not be fully aware of digital security essentials, so consider these must-dos. Utilize a hardware wallet, like Ledger or Trezor, for anything beyond small test amounts. This approach secures your private keys offline. Never share your seed phrase with anyone, no exceptions. Scammers impersonating support often ask for it, which is a trap. Verify website legitimacy. Phishing links abound. Ensure that you're on the authentic app, e.g., oasis.app for DI savings, app.aave.com for Aave. Bookmark these sites, or use aggregators like Zapper or DeFi Saver to manage multiple protocols without risking contact with false sites. Begin with small investments to build confidence. If an offer claims extremely high yields, like 100% APY, tread cautiously. It's likely highly risky or a scam. In DeFi, high double-digit rates usually derive from new token rewards or unsustainable schemes. We're advocating for single-digit yields as they stem from real economic pursuits, such as trading fees or interest. Weigh custodial against non-custodial. If you're uneasy managing your wallet, sticking with reputable custodians, like Coinbase, may be suitable initially. Non-custodial methods, where you control the keys, align best with DeFi philosophy, yet require a degree of personal responsibility. Retirees often benefit from the assistance of a financial advisor or tech-savvy family member to help with setup. Example strategy for a risk-averse investor. If you have $50,000 to invest in crypto for yield, capital you won't need immediately, and you accept the associated risks, consider the following allocation. $20,000 into DAI deposited in the DI savings rate at 7%, potentially yielding $1,400 per year if the rate persists. $20,000 into USDC on Aave, generating a projected 3% yield. This results in $600 annually. $5,000 invested into staked ETH through a tool like Lido, yielding 5%. This amounts to approximately $250 per year in ETH, plus possible price increases or decreases. Retain $5,000 liquid in USDC in a secured wallet for emergencies or new opportunities. Although this won't yield interest, it serves as a cash reserve. Optionally, consider purchasing Nexus Mutual Insurance for your $40,000 in DeFi investments, DAI and Maker and USDC and Aave. This may cost around 2% annually on the covered amount, totaling approximately $800. This will reduce your net yield from $2,000 to $1,200, but may be worth the peace of mind it affords. Without insurance, your investment could generate around $2,000 from a $50,000 investment, resulting in a blended yield of 4%. Including insurance would adjust it to approximately 2.4%, depending on your risk appetite. Even yields of 2 to 4% are competitive or slightly better than current bank CDs. If external interest rates decline, DeFi yields may still hold steady due to persistent on-chain demand. Importantly, you can withdraw funds anytime, with a note that staked ETH has a 1-month withdrawal period, unless utilizing a liquid staking token that trades instantly. In the present moment, Maker's DI offers an 8% yield, while Aave stands around 3%. These rates fluctuate, so regular reassessment is necessary. Quarterly checks to monitor shifts in rates or significant updates, like protocol upgrades or emerging risks, are advisable. However, note that this doesn't equate to day trading. Wrapping up, key do's and don'ts. Focus on stable, large-cap assets for yield. Stablecoins, ETH perhaps. Utilize dependable DeFi protocols, considering diversification across multiple platforms. Ensure your devices are secure. Update software. Utilize hardware wallets. Contemplate insurance for complete peace of mind. Avoid chasing extreme yields or unproven projects. Never invest more than you can afford to lose in a somewhat volatile arena. Stablecoins still carry risks, such as regulatory uncertainties or potential depegging. Remember to account for potential taxes on interest. Even if you don't cash out to fiat, those additional DI or USDC might still be taxable income. Do not neglect the broader portfolio. DeFi yields can augment traditional investments but should not entirely replace them. Balance is crucial. One last thought on regulations. By 2025, clearer regulatory frameworks are anticipated for crypto across many regions. Some DeFi yields may be limited for US users, as seen with Aave geo-blocking US IPs. If that's the case, utilizing compliant US-based platforms like Coinbase may be the best path forward. Always adhere to legal guidelines. For retirees in particular, consider involving a trusted family member or financial advisor for first-time setups. Once this process is initiated, it can be relatively low maintenance. It may even prove enjoyable. Interest can accumulate quickly in certain apps, offering more transparency compared to the monthly updates typical of bank accounts. With thoughtful planning, DeFi can serve as a reliable income source with manageable risks, catering even to those with a low-risk tolerance. The key lies in selecting the appropriate tools. If you found this guide valuable, please like and subscribe. Should you have questions on any step, feel free to leave them in the comments. We're eager to assist. Here's a question for viewers. What's your top low-risk crypto yield strategy at the moment? Share your insights, particularly if you use these strategies in a retirement context. Thank you for joining us. Remember, the goal is to enable your money to work for you without constant concern. With these strategies, you can engage in the crypto revolution responsibly. Happy earning and stay safe.